Welcome everyone to today's webinar series brought to you by the Voluntary Benefit Shop. We're going to give people just a few more minutes to join us before we get started. Again, thanks everyone for joining us today. Thank you for your promptness. It's just about 1 o'clock right now, 1 o'clock Eastern time. We will get started here in just about another minute or two with today's presentation. Chelsea, and let me know you can hear me okay?
Yes, Mike, I can hear you.
Okay, great. Thanks to everyone who's joined us so far today. We're going to get started with today's program in just about another minute. Chelsea, we'll give it about 30 more seconds and then we'll get it kicked off.
Great.
Okay, let's go ahead and get started. Thanks everyone for joining us today. My name is Mike Walker from the Voluntary Benefit Shop. Those of you that are new to our webinar series, welcome. We try to do this once a month and give you all some good information that can help you be more informed about kind of long-term care in general, life with long-term care options. Sometimes it's legislation, a lot of different things we talk about on this webinar series. But I do appreciate you taking the time to join us. We are recording today's session, so certainly feel free to enter questions into chat. Feel free, we'll give you an opportunity to unmute at the end and ask questions as well. Also, again, like we said, this will be recorded. It's then kept on our website, so if you do want to go, back to our website and reference it, you can as well. So just know that. Okay, so with that said, let's go ahead and get started with kicked off with today's program. Again, my name is Mike Walker from the Voluntary Benefit Shop. We are a life with long-term care specialist. This is all we do is bring life with long-term care to clients and to consultants. We have a very specific process for introducing, onboarding, enrolling, and servicing that product, which creates tremendous results. Here's my contact information. If you want to reach out to find out about how you can, bring the best in life with long-term care solutions to your clients, please feel free to reach out to us. You can also check out our website here as well. So thank you very much again for your attendance today. I do want to promote an upcoming webinar that I have coming up in March. We will have a webinar on March the 20th at 1 p.m. where we'll be focused on the latest updates for long-term care payroll tax conversations that are happening at the state level around the country. If you're not, really in the know on that, there's been a lot of activity over the first 6 or 7 weeks of 2025. Some interesting things going on with different states. So be sure to mark that for your calendars, and those invites will be coming out, over the next, couple of weeks. Again, that's coming up on March 20th. Okay. So today we're going to review 5 life with long-term care options, guys, and this is really meant to be a kind of a high-level overview, and we're just going to talk a little bit about some of the features of each of the different carriers that really have this type of product. Right now in the marketplace, you have 5 options. There are a couple of smaller players out there that have some options too. We didn't really include them as part of that just because either they're not really relevant across the country, or they're not, necessarily, they're not necessarily super well-known companies. But right now, you really have 5 main options. You have Transamerica, you have MetLife, Allstate, Trustmark, Chubb. Again, we're going to review some of the features of each of those plans and just talk about how their plans work. Before we do that, just a couple of things to consider when you think about these life with long-term care options and just the overall need and desire for long-term care. Here's a couple of benchmarking statistics. The increase for new premium on these hybrid products in 2023 was about 22%. I'll be interested to see what the 2024 number looks like. I think it's going to be higher than that, industry-wide. But the interesting things I think to look at on this are some of the stats that came from the Eastbridge study. 36% of employees say that they wish their employer offered long-term care. Look at the generational mix. It's not just us Gen Xers and the boomers. It's Gen Z and millennials as well that really wish that their employer offered long-term care. 29% of companies said that they intend to offer or are interested in offering long-term care in the future. And look at this last stat. 51% of employees say that they would be interested in purchasing long-term care if their company offered it on a voluntary basis. So this is a product that people, want, they need. It's a huge opportunity for all of us. Really, it's just about having, a system in place to really introduce it to your clients and then be able to educate, properly educate employees on the options. The bottom of here, look at some of the stats on increase in sales for these products. Allstate reported to me that they had about a 10% increase in the sales of their life with long-term care products in 2024. Transamerica, about a 50% increase. They introduced a new version of their product with a true LTC rider, and that probably really drove sales there, but they had a huge 50% increase in the sale of their life with long-term care product. And then Trustmark reported to me that they had about a 15% increase in the sale of their products. So across the board, the carriers that really focus on this have had tremendous sales increases over the last several years. There's a couple of interesting stats, maybe refresher stats for some of you, but 70% of us after the age of 65 will need some shape, form, or fashion of long-term care services, and 20% of us will need that care for longer than 5 years. So this impacts a really large part of the population. And then here's a snapshot of what costs look like. The median annual cost for an in-home health aide is about $75,000. The annual cost of care in a nursing home is about $104,000. The annual cost of care for a private room in a nursing home is about $116,000, and the estimated cost of care for the final 5 years of life for a person with dementia is about $367,000. So, these are big costs. It doesn't take long to really, when we think about our clients, to think about how this can really negatively impact, family financial security, retirement assets, the financial security of healthy spouses. And I guess that's all bad news, but the good news is hey, that's what we do every day, right? We educate people on how they can protect themselves against risk. And specifically, this gives us an opportunity to educate our clients and their employees on how they can protect themselves against this risk and this exposure. So before we kind of go into some of the differences and features of the different organizations, different carriers out there in their life with LTC options, I wanted to just kind of share some general plan structure details with you for some of you that are maybe new to this conversation. So these plans, typically have maybe 4 components to them. And the options can have, all of these components, or maybe sometimes they only have, 3 of these components, maybe in some instances. But the components are essentially on this diagram. Top left-hand corner, there's usually a death benefit that makes up these programs. And the employee is going to choose a death benefit when they select the option. And then the plan's going to work just like you would expect life insurance to work. It's going to pay the insured their beneficiary, whatever that death benefit was that the employee chose when they elected the plan. The top right-hand corner, there's generally a terminal illness component where it's going to advance a percentage of that death benefit to the insured. In this case, we're saying 75% if that person is diagnosed with a terminal illness. The bottom right-hand corner is a long-term care rider, and that's going to pay a percentage of the death benefit to the insured when they go through a long-term care situation. In this example, we're saying it's paying 4% for up to 25 months of long-term care. After that 25 months has been exhausted, there's another provision that can typically be added to these plans, which provides for an extension of the long-term care benefit, which essentially doubles the long-term care benefit. So in this case, it would provide 4% monthly of the death benefit for an additional 25 months. And then also there's generally a provision that can be added to the plans that restores the death benefit so that the death benefit, stays whole and that the insured's family would still receive the full death benefit even if they have access to long-term care benefit. And that's called death benefit restoration. The bottom of the screen really details, what triggers the long-term care benefit. And typically that's, what you're probably all familiar with in terms of triggering long-term care. It's 2 of the 6 activities of daily living, or of course, severe cognitive impairment. And that's pretty standard on all these policies for being the trigger for long-term care benefits. So I know it can be a little tough to follow those percentages. So let me just give you kind of a real numbers example just to paint the picture for those of you that are maybe new to the conversation. Let's say that I was a policyholder and I took a $100,000, face amount policy. And let's say I pass away. I have a heart attack. I have an accident. I never need long-term care. I just pass away. Well, it's going to pay my family that $100,000 death benefit, just like you would expect life insurance to work. Now, the top right-hand corner, I'm diagnosed with a terminal illness. It will advance me 75%, or in this case, $75,000 right away. And then the remaining $25,000 paid to my beneficiary at time of passing. Bottom right-hand corner, this is my long-term care. In this instance, it's going to pay me 4%. Or $4,000 per month for up to 25 months of receiving long-term care. After that 25 months has been exhausted, again, typically then it'll trigger an extension of benefits, which will extend my long-term care benefit for an additional 25 months at that same $4,000 a month level. And then even if I exhaust all of that, it'll still typically pay my beneficiaries that full death benefit when I pass away, which in this case would be $100,000. So you can see with a $100,000 plan, I may receive $200,000 of long-term care benefits plus a $100,000 death benefit payable to my beneficiary for a full, total benefits of $300,000 on my $100,000, face amount life insurance plan. And that's a pretty typical plan structure for these types of plans. Now, just to give you another, framework of a plan structure, some of the carriers may do a 6% monthly long-term care benefit, which would pay on that same $100,000 plan would pay, of course, $6,000 a month, but for a shorter time period. With the extension, instead of 50 months, that would be 34 months, but then still with the full, death benefit restoration. So some of the carriers have, different options for that, and we'll talk about that when we kind of look at the various carrier options. Now, these hybrid products are very, very appealing to people, folks, for a number of reasons. Again, if you're, kind of new to this conversation, number one, people like these hybrid products, here on the left-hand side of your screen, because when I buy one of these products, when I pay for one of these products, I know I'm paying for something that one way or the other is going to pay me a benefit. Either I'm going to pass away and my family's going to get the life insurance benefit, or I'm going to need long-term care benefits and my family are going to get those benefits. And in many instances, both of those benefits are going to be paid. But one way or the other, I'm paying for something that's going to pay a benefit. And that's, I think, one of the big reasons why people are much more apt to buy this than the old standalone long-term care insurance that was offered, back in the day. Also, guaranteed acceptance underwriting, so people can get a very high level of coverage without having to answer health questions. Typically, the plans have level premiums, so they're locking in a rate that they're going to be able to keep moving forward. Most of the plans are on whole life or universal life chassis, so they are accumulating cash value over time, so people are literally creating an asset that they own, that they can take loans out against or cash it in the future. The plans are typically indemnity products, not reimbursement products, which means that they're going to pay benefits regardless of the cost of service, right? So let's say I'm getting care in my own home and my spouse is my primary caregiver, right? I'm not going to get a bill for that, but because these are indemnity products, they can still pay benefits even in those types of scenarios with just some very minimal certified care requirements being met. And the plans can pay benefits during informal care in many instances, which is what we're just talking about. For example, my spouse being my caregiver, that would be considered an informal caregiver. So all of those are reasons why these hybrid products have become very, very popular to people. So, here's kind of just a general spreadsheet, and this is not meant to be, kind of the Bible on pros and cons, because this is, could vary on different groups and that type of thing. But I did want to point out a couple of things on here that are kind of general features of some of the carriers. So one of the things I'd like to point out is that, MetLife, who's pretty new to this game, they brought their product out last year. They have the highest maximum benefit amount. They have a $5 million maximum benefit amount that is available to people. And so there may be some executive circumstances where maybe that product may be appealing because of that high level. Beyond that, Transamerica has the second highest maximum benefit. They can go $5 million, or I'm sorry, 500,000 of life, $1 million in LTC on the Transamerica option, because they have the extension, which makes the LTC benefit double the life insurance benefit. So that's a pretty nice high level of life and LTC there as well. Now, if you go down here a little lower where we talk about the monthly percentage of LTC, you can see the carriers kind of vary amongst this. The Allstate and Transamerica, they offer either 4% or 6% options in many states, whereas Trustmark is pretty much a 4% option. Chubb is pretty much a 4% option. MetLife is a standard of 5%, but people can really adjust it at time of claim between 2 and 10%, so it offers some flexibility there. And so I guess that's a positive. The other thing to think about is certainly that amount that they advance is going to also impact the number of months that benefit can be paid for as well. So typically, with your 6% option, you're talking about a 34-month LTC benefit. With the 4% option, you're talking about a 50-month LTC benefit with the extension. So that can vary depending upon what that monthly amount is. On the MetLife thing, the one thing I'll say is they do not currently have the bells and whistles of the extension and the death benefit restoration. So my long-term care benefit is going to be limited to the total amount of my death benefit, versus with the other carriers, their LTC benefit is typically going to be a multiple of the death benefit. So typically it's going to be twice the death benefit. So if I have a $100,000 death benefit, I'll probably have a $200,000 long-term care benefit with the majority of the other carriers. Whereas with MetLife, it's currently limited to whatever my death benefit is. One other thing I wanted to point out just kind of in general is that the Transamerica option, MetLife option, and Chubb options do not have any pre-existing condition limitations for the long-term care benefit, versus Allstate and Trustmark do have 6-month pre-existing condition limitations. Not always a huge factor, but definitely something that's worth, conversation and worth noting with the clients as well. And then another thing I wanted to point out is possible reduction in benefits. The Trustmark has an option where the life insurance benefit can reduce by 2/3 at age 70. Now, all of their plan options don't have that, but one of their plan options does have this death benefit reduction. It doesn't reduce the long-term care benefit, but it does reduce the death benefit at 2/3 at age 70. And then the Chubb option does have a possible 50% reduction in benefits at age 100. And that's actually a reduction of both LTC and death benefit on that reduction there. So definitely something worth noting. And then in terms of cash values, you can see all the plans have different cash values. Obviously, the whole life options, the cash values are stable. The universal life options can have a fluctuating interest rate. What we have indicated here are the guaranteed interest rates. On the Chubb option, it says none because the Chubb is actually a term to 120 program, so it does not have a cash value associated with it, versus Allstate and MetLife are whole life options. Trustmark and Transamerica are typically universal life options. Transamerica does have a whole life option in some states, and Trustmark does have a term life option in some states, but typically with those carriers, it's the universal life option. Okay, so let's dig in a little bit more on some of the pros and cons or the, not pros and cons, but features and highlights of some of the different carriers. So Transamerica, again, as I said, it's typically a universal life policy. Now they do have two rate structures. They have what's called a high face amount and a high cash value rate structure. Generally, if you're offering something for the LTC benefits, you want to go with the high cash value rate structure because that's a plan structure that's designed to last for a lifetime. So that's the direction you want to go with the Transamerica, is the high cash value rate structure. Transamerica typically does offer a really high level of guaranteed issue for all size cases, and they have a high max benefit available. Again, $500,000 of life, $1 million of LTC. They do have the extension of benefits and the death benefit restoration rider available in most states, and they offer life insurance for both children and grandchildren on their policy as well. They also only require one certified care visit per month to receive full LTC benefits. That's nice. They have very minimal participation requirements with us, with our block underwriting offers. And this is also kind of timely. Their long-term care rider on their UL plan is 7702B compliant in most states. That could be important as time goes on. Well, it's important today, but it could be even more important as time goes on, because as more states implement life with long-term care payroll tax legislation, some of them may require that the plan be 7702B compliant for people to be exempt from the tax. But beyond that, it's also important because as people look to use maybe HSA money to pay for LTC, or for people to have to be able to take potential tax write-offs or tax credits for having LTC insurance, it has to be 7702B compliant. And that is, those tax credits are becoming more of a conversation at the federal level as well. So again, 7702B compliance could be something that, while it's important today, could be even more important, down the road. So nice that Transamerica has that, that feature. Points to consider on Transamerica. Again, the HFA option is not really a permanent policy. So again, I would make sure you go the HCV, high cash value rate, when you do Transamerica. They currently don't have living benefits riders in a couple of states, and there's some states that they don't have extension of benefits riders in as well as of yet. I know they're working in those states to kind of round it out in those states. So great option with Transamerica, great options with them. Next, Chubb. For some of the highlights with the Chubb program, for some ages, it is often the least expensive option, but remember that's because it's a term to 120, so it doesn't have any cash value. So that lends itself to, in some instances, being less expensive. It does have the extension of benefits rider in most states. It does have up to a 75-month long-term care, per benefit on their program. That may be nice in some instances. It has a 50% death benefit restoration, and their plan is a true LTC rider, which should qualify employees for an LTC tax exemption in applicable states. For example, when the state of Washington had their program, it did qualify people for the tax exemption when they rolled that out. Now, points to consider on Chubb: it is a permanent it's a permanent term product, not a permanent life product, meaning it doesn't have cash value. It currently does not have the extension of benefits rider in several states, and the plan may reduce benefits at age 100. So that's definitely something to keep in mind. It actually, the age used to be age 80 previously, but it actually just changed to age 100 in a recent change in their product language. So it is something to know that the LTC benefits and the life insurance benefits could reduce benefits at age 100. Doesn't say it will, it says it could. Okay, Allstate, they're generally a whole life option. Okay, for smaller groups, say groups under 100, they're typically going to have the highest level of guaranteed issue, at least with our underwriting offer. So for groups under 100, that's typically the case. Now, once you get over 100, all the carriers are typically going to give you pretty good underwriting offers. It's in that small group segment where they may be a little higher than the other carriers. They do typically have the highest spouse guaranteed issue, and again, that's going to be more prevalent in the smaller cases. Again, the larger the cases are, the more the other carriers are going to, give you some flexibility with underwriting for spouses and that type of thing. They do have the extension of benefits in most states. They do offer life insurance coverage for children. They do have minimal participation requirements. Their rider is a true LTC rider, although it's a 101G, right, which is different than than what we talked about with Transamerica with the 7702B compliant program. 101G should qualify employees for LTC tax exemption in applicable states. It did in the state of Washington, but it is not it is not one that allows for, you can't use HSA funds to pay for it. You can't use it for the federal tax credit and that type of thing. So a little different than 7702B, but it is 101G, okay, which is a different provision of the Internal Revenue Code. It also, Allstate does have a true inflation rider in California, meaning that the LTC benefit does increase with inflation or with an inflation rider over time. That may be coming to other states as well. It is a nice rider, and I think you'll see other carriers following suit with this as time goes on as well. But that's a nice aspect of their plan in California. Points to consider: there are some states where they do not have a long-term care rider, okay, at this point in time. They're certainly not able to do business in New York currently. They currently do not have an extension of benefits rider in some states. And their long-term care benefit does require 2 certified care visits per month. You remember when I talked about the Transamerica plan, it only requires 1 certified care visit per month. So 2, not bad as 2 per month, but certainly not the least restrictive. Trustmark. So this plan, Trustmark has both universal life and term life options. They can sometimes have the lowest price points for many ages, but there are some reasons for that. We'll talk about that. When it's an apples to apples comparison, it's not always the lowest, but they do have some low cost options, we should point out. They do have an option in New York. I point that out because there's not a lot of options in New York. It's called a convalescent care rider in New York, which is similar to long-term care. They do have the extension of benefits rider, although I should point out they do not have that in New York. They do offer life insurance coverage to children and grandchildren. The rider is a true long-term care rider, and it, again, should qualify employees for tax exemption in applicable states as they do pass life of long-term care payroll taxes. The term life option for the LTC rider is 7702B compliant in most states. The LTC rider is not 7702B compliant in most states, although they are filing that in states, and I guess over time it'll be 7702B compliant, but not in most states at this point in time. The term life option is in many states is 7702B compliant. Couple points to consider. Again, there are some states where they do not have the long-term care rider. There's certainly some states where they do not have extension of benefits. They certainly, in the smaller cases, provide the lowest guaranteed issue for smaller cases. So something to keep in mind. They also have some versions of their plan which reduce the life insurance benefit, as we said earlier, by 2/3 at age 70. So definitely something to keep in mind. And that's why they typically do have the lowest price points for some ages, because of that death benefit reduction. Okay. So if people don't mind if the death benefit's reducing by 2/3 at age 70, maybe that's not a problem. But it is, something to keep in mind. They also generally have the lowest spouse guaranteed issue as well. Okay. So again, good option, just certainly some things to keep in mind. And now the newest option, the MetLife option out there, their plan is a whole life plan. As I said, they do have the highest max benefit of $5 million. They also have the highest potential guaranteed issue generally, because the guaranteed issue can go up to $300,000, but it's based upon the income. Okay, it can be 2 times salary, not to exceed $300,000. So it's a little more complex about how GI works there. GI is based on income level there. The LTC percentage is flexible by month. It can be 2% to 10%. They only have annual verification of continuity of benefits for claim. That means that when somebody's out on claim, they only have to verify LTC, 2 or more of the ADLs or severe cognitive impairment once per year. Some of the carriers require it to be more often than that. The plan is available in New York and Massachusetts. Okay, so that's good because most of the other carriers do not currently have options in New York or Massachusetts with true LTC. Okay, so that is something to keep in mind. They do not currently have the extension of benefits or restoration of death benefit rider. Okay. That's a big deal, guys. I mean, they do have it filed in many of the states, but certainly that's part of what makes these products so appealing, is that extension of benefits and restoration of death benefit. So they're in the process of fixing that, but currently they do not have that in states. They do generally have a higher participation requirement. Sometimes they'll be flexible with that, but they do generally have a higher participation requirement than most of the other carriers. They do have a perpetual guaranteed issue that ends if someone did not take something the previous year. And I think just the fluctuating guaranteed issue amount, potentially makes the plan a little harder to explain or to administer on an ongoing basis. So anyway, those are those options. Now, I did want to point out that there are some other carriers getting into the market. Guardian and Aflac Group have carrier options that should be out sometime during 2025. I've talked to both of those carriers, and they're working on some interesting things. I think, so they may have inflation rider in some states and some things of that nature as well. So I don't want to talk too much about their plans, right? Because they're not, out yet. But from the conversations I've had with them, it does look like they'll have some interesting options that'll be out there. So as those options come about, we'll be sure to keep you guys informed on what those options are. Looks like we're right about on time there, up to time, guys. So I'm going to open it up for questions now as we kind of move to the end of this. Does anyone have any questions for us? And Chelsea, do we have any questions in chat? Anything in chat, Chelsea?
We do not have any questions in the chat at the moment.
Okay, guys, I'll pause and let you guys ask questions now if anyone has any questions that they want to ask, or feel free to put a question into chat and we'll answer that as well. I'll also give you my contact information up here if you want to shoot me an email to discuss anything specifically, or if you just have just want to reach out generally. So here's my contact information, and I'll pause again just to see, does anyone have any questions?
Mike, we do have one question in the chat. Michelle would like to know, which carrier do you see most commonly chosen by employers?
I really think that that it depends on the situation, right? I don't think there's one that all clients are choosing. I will say that MetLife has been in the game the shortest amount of time, and because they don't currently have the bells and whistles of the extension and the restoration, that they have not been on the list of carriers as often as some of the other ones. And then I will also say that I think Allstate and Transamerica tend to offer more flexibility in terms of like underwriting and participation and those types of things as well. And they'll also, both of those carriers are also more able to handle some of the cases that are maybe smaller. Like some of the carriers like MetLife, they don't necessarily want to go below 500 or 500 lives, and whereas with Allstate and Transamerica, they're certainly able to go under 100 lives as well. So I think those are probably the ones that are more common because they can handle more carrier sizes. But all the carriers have pros or have advantages and features that, are worth considering. Sometimes it comes down to what's most important to that client. Is it having the most robust product? Is it having the least expensive product? Is it a participation requirement? It really depends on what's most important to that client. Any other
Mike,
questions?
Mike, we have two additional questions in the chat. The first one is, what is your favorite all-around carrier for this product and implementation?
Um, I don't know that I have a favorite carrier. I do, like I said, I think that, Allstate and Transamerica offer the most flexibility, right? Like I think but in some instances, it depends on the state that they're in. For example, in New York, I have much more limited options than I have in other states. So while I like the features of, I'm certainly going to choose a carrier when I have the choice. I'm going to choose a carrier that has restoration and full extension of benefits. Okay. Because those are the features that make these products appealing to people, is that extension of long-term care and that death benefit restoration. So I'm always going to choose a carrier that has those features. We tend to have the best underwriting success with Allstate and Transamerica as well. But it really just depends on the state and that specific client. Okay. Chelsea, I think there was another question maybe that I didn't answer.
Yes, the last question is, Dory would like to know, where does technology sit when offering this benefit? Can all carriers build it on platforms?
Dory, that's a really good question. So, my recommendation to clients is to never put it on their technology, right? Like I never want it built on their ADPs, the B Swifts, the UKGs, et cetera, for multiple reasons, right? Number one, I always want to have enrollment for this product off of cycle. That's how we're going to get the best participation. And number two, most of those technologies, ADPs, UKGs, B Swifts, et cetera, are not equipped to be able to handle EOI. So if people go above guaranteed issue or they're a late entrant and that type of thing, and EOI is recovered or required. So we always enroll these products on Celerix. Okay, Celerix is the platform that we use, and that product or that platform is able to handle a couple of things. They're able to handle the EOI process, number one. They're also able to handle stacking of policies. So remember, with these plans, they're typically issue age products. So if I take coverage at age, let's say I take $50,000 worth of coverage this year, I'm 53. And then 5 years from now, I want to add another $50,000 worth of coverage at age 58. That's going to be two separate policies at two separate ages at two separate rates. Well, ADP can't handle that. UKG, those platforms can't handle that, whereas Celerix can handle that. So we are almost always recommending to clients that it's not enrolled in their BIN admin systems. We enroll it outside of that on Celerix. We have certainly in the past probably been guilty of trying to enroll it on ADP and those type of things, and it's never a perfect experience. It's always better, in my opinion, to do it outside of those technologies on Celerix. That's my opinion, Dory. Okay. Any other questions on that at all?
We have one additional question that just came through. Michelle would like to know, she said, we have some employers like direct bill versus payroll deductions for least admin / ability for employees to keep for lifetime. Do you have any thoughts / philosophy on this?
Yeah, so yeah, we do have some clients that do direct bill, and it can work well in some industries, right? Like it certainly probably depends on the industry whether or not employees are going to be more apt to embrace direct bill, whether that be through bank draft, credit card, et cetera. Certainly it does lend itself to the business staying on the books longer and people having ease of keeping it when they change employment and things of that nature. And so there is some value to that, certainly. Some of the carriers are more apt to do that for certain size cases than other carriers are as well. And sometimes you doing it direct bill with some of the carriers will also impact what the underwriting offer is going to look like as well. But for the most part, most of the carriers do have the ability to be able to do it direct bill. And most of them, will provide you with that with that opportunity to be able to do it. We do the vast majority of ours as payroll deduct, but we do have some clients that do it direct bill. It really just depends on the industry, whether or not it's going to be well received that way. Any other questions?
As of right now, we do not have any questions in the chat. We do have one person typing if you want to give it just a second.
Sure.
But other than that, that was our last question at this moment.
Sure. And again, you guys can unmute and ask a question if you choose to as well. Anyone at all?
No, I'll just say, Mike, thank you. It was very informative and appreciate it.
Dory, really appreciate your questions today. So thank you very much.
Mike, we had one additional question come through in the chat. David would like to know, what is your minimum size group or a number of eligibles? Sorry.
Yeah, so we can actually go all the way down to, say, 3 lives or 5 lives, depending on the carriers, right? So there's not necessarily a minimum size. I can get a group with some level of guaranteed issue all the way down to 3 apps. So, it can be as little as that. So we work with companies that have, anywhere from, say 3 or 5 employees up to organizations that have, 40, 50,000 employees. So we can work with all size organizations. Any other questions?
That was the final question in the chat.
Hey guys, really appreciate your time today. Thanks for the great questions. Here's my contact information, so certainly feel free to, reach out if you have any additional questions. We're here to help. And if you want to talk about, bringing life with long-term care solutions to your clients and how we can help you do that in a way that really helps you create a great revenue stream, reach out to us. We work with brokers all throughout the country. Most of the national organizations, work with us on some level, as well as many regional and local brokers as well. So feel free to reach out. I appreciate your time today. Thanks so much, and have a great rest of your day.